Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Guangzhou Automobile Group Co. Limited annual report. Guangzhou Automobile Group Co. Limited is a diversified automotive conglomerate that offers a wide range of businesses and services. At its core, the company produces and sells vehicles, including passenger cars, commercial trucks, buses, and motorcycles. These products cater to various segments, from sedans and SUVs to heavy-duty trucks and new energy vehicles. In addition to vehicle manufacturing, Guangzhou Automobile Group also engages in the production of automotive parts and components. This includes engines, gearboxes, car seats, micromotors, and other essential components that are used in the assembly of its vehicles. The company's portfolio also extends to motorcycles, with a focus on sport bikes, scooters, electric bicycles, and motorcycles. Beyond manufacturing, Guangzhou Automobile Group offers various services to support the automotive industry. These include logistics, second-hand vehicle sales, supporting services, and mobility transportation services. Furthermore, the company provides financial services such as automobile credit, insurance brokerage, financial investment, finance lease, and other financing options. The company also engages in trading activities, buying and selling automobiles, automotive parts, and steel products. With a presence in mainland China and internationally, Guangzhou Automobile Group Co. Limited has established itself as a significant player in the global automotive market. Guangzhou Automobile Group Co. Limited maintains a market capitalization of $76 billion, broadly in line with the industry peer group. Guangzhou Automobile Group Co. Limited trades at a lower price-to-book ratio of 0.27 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 48% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. While the company is able to service its interest expenses from operating income, the presence of recurring special charges raises concerns about underlying earnings quality. Investors should monitor whether these charges reflect ongoing operational inefficiencies. The primary drivers of revenue growth or decline can be identified through a thorough analysis of the extracted summaries. Revenue growth is primarily driven by several key factors. Firstly, the increase in overseas terminal sales volume by approximately 48% in 2025 has significantly contributed to revenue growth. Additionally, the commercialization of autonomous driving technology and the introduction of new products, such as the Quark Electric Drive 2, have also played a crucial role. Furthermore, the growth of NEVs, new energy vehicles, with a 29% year-on-year increase in production and sales, has been a significant driver of revenue growth. Another key factor contributing to revenue growth is the expansion of international business, particularly in the European market. The launch of new overseas models and accelerated localized operations have also contributed to revenue growth. Moreover, the increased production and sales volume of power batteries, as well as the growth of commercial vehicles, with a 322.38% increase in sales volume, have further boosted revenue. On the other hand, revenue decline is primarily driven by several factors. Firstly, the decrease in annual automobile sales volume by 14.06% has significantly contributed to revenue decline. Additionally, the decrease in sales volume of vehicles under self-developed brands and the increase in asset impairment provision of intangible assets and inventories have also played a crucial role. Furthermore, fierce competition in the automobile industry has led to a 10.43% decrease in revenue for GAC Trumpchai and AION. The decline in passenger vehicle sales volume by 14.23%, as well as the significant decline in sedan and MPV sales, have further contributed to revenue decline. The net income of the company underwent significant fluctuations between 2025. Initially, it increased by approximately 48% year-on-year in 2025, indicating a positive trend. However, this growth was short-lived as it decreased by 2.8% due to intensified market competition. Further analysis reveals that various factors contributed to the decline in net income. The phase-out of purchase tax subsidies had a direct impact on the company's revenue. Additionally, increased investments and volatile raw material prices also played a role in this decline. In terms of profit margins, there was an improvement, although it is not explicitly quantified. However, when compared to other downstream industrial enterprises, the company's profit margins were lower than average. The most significant decline in profit margins occurred due to the phase-out of purchase tax subsidies and stricter technical requirements for new energy vehicles, NEVs. As a result, the profit margins decreased by 50%. The company's debt level has undergone significant changes over the past period. Initially, there was no significant change in debt level, page 4. However, subsequent reports revealed a mixed picture. On one hand, loans and borrowings increased by 20.6%, page 5. While lease liabilities decreased by 14.1%. On the other hand, borrowings non-current decreased by 18.98%, but borrowings current increased by 20.41%, page 44. Furthermore, total borrowings remained unchanged at RMB 37.78 billion, page 46. Nevertheless, an increase in total assets by 2,069,116 indicates a rise in debt level, page 50. In terms of interest expenses, there has been a notable increase. Interest expense on loans and borrowings rose from RMB 519,882 to RMB 580,353, page 13, while interest expense on lease liabilities decreased from RMB 88,154 to RMB 80,316. Additionally, interest expenses increased by RMB 76 million, page 42. These changes suggest that the company's debt level and interest expenses have undergone significant fluctuations over the past period. Management is presenting a mixed outlook on the company's future. On one hand, they are confident in their strong industry position and advanced manufacturing capabilities, which will enable them to maintain market competitiveness through continuous product line enrichment and optimization. They are also investing in strategic projects for new energy vehicles and accelerating transformation in commercial vehicles. However, management acknowledges that profitability will be severely challenged due to the phase-out of purchase tax subsidies. This has already led to a decline in income from joint ventures, which is expected to continue as the company transitions to new energy models. Despite this, they are optimistic about improving quality and promoting new energy vehicle models and core components through independent research and development. Overall, management's strategy appears to be focused on adapting to changing market conditions and investing in emerging technologies such as new energy vehicles. While there may be short-term challenges, they believe that these investments will ultimately drive long-term growth and competitiveness. The company has a history of paying dividends to its shareholders. According to the provided information, GAC Toyota, GAC SOFINCO, and Wying Honda have all paid dividends in the past. Furthermore, it is confirmed that the company paid dividends in 2024, with interim and final dividend payments totaling 514,126 RMB 0. Although there are proposed but not yet paid dividends for 2025, this indicates a continued commitment to rewarding shareholders through dividend payments. Concerns about inventory buildup or supply chain disruption have been raised in various sections of the report. On page 41, it is explicitly stated that these issues are a concern. The logistics and warehousing fees increased by RMB 448 million on page 42 suggest potential problems with inventory management. Additionally, an increase in inventories of 4.83% on page 45 further highlights the issue of inventory buildup. However, not all sections of the report mention concerns about inventory buildup or supply chain disruption. Pages 2, 29, 34, and 50 do not raise any such concerns. Nevertheless, geopolitical risks and rising trade protectionism are mentioned as potential causes for supply chain disruption on page 57. That concludes the financial summary for Guangzhou Automobile Group Co. Limited. Feel free to comment below, and I will be happy to answer them when possible.